I see people doing two things. Either obsess over what stocks to buy or what ETF or what investment strategy to pick, or just buy funds and crypto or whatever randomly. But what to buy is actually not what really matters for your private portfolio and its performance. Because there are two things that are often overlooked but can have a tremendous impact on the wealth creation. And those two things are asset allocation and cost. Let's dive in. Now imagine you're making a bolognese, and to create it you need different ingredients like the meat, the tomato sauce, different vegetables, celery, carrots, garlic, onions, and the spices. Now financially speaking, each ingredient represents a certain asset class. Now like the category of vegetables or the category of meat, asset classes are investments that have similar characteristics. And those characteristics can be how much risk they bear, how much return you can expect from them, their liquidity, and how they behave in the market. Now when you put together your bolognese, you decide how much of each ingredient you put in there and in what relation. So maybe you're a vegetarian, then you leave out the meat. Or you love the taste of celery, so you put a little bit more of that into it. Maybe you like to go by the book and you take the ingredients just like in the recipe from a famous chef. So you give this bolognese your own unique touch and you build it around your preferences. And you do the same with your portfolio. So you think of different asset classes and then you mix them together in a way that feels best for you and your unique situation. You balance the risk and the return of your meal, i.e. portfolio, and your risk tolerance is an important part of that. So some people like to be on the very safe side, so they're rather risk averse. Others are maybe more risk seeking. And you will also tailor your asset allocation according to your financial goals. If your goal is long-term wealth creation, you might lean a little bit more into stocks. If your goal is to preserve wealth, you might stick to bonds or cash. And then everything put together will make a nice and delicious meal. So put into financial terms your personalized asset allocation. And the risk has always to be considered for the whole portfolio, not just different parts of the portfolio. Because if one carrot in the pot is not as sweet as the others, it won't matter because you won't taste the difference. If you buy crypto and it's between 1 and 5% of your portfolio, it obviously isn't as risky as if it were 100%. That's why it matters so much to determine the asset allocation before starting to invest. If you start at zero and you put your first 10,000 basically of everything into one stock that you haven't researched and you want to use the money for a vacation 1 year later, that is very high risk. On the other hand, if you have 10,000 and you put 2,000 into cash and 8,000 into a well-diversified low-cost index fund and you plan on holding this investment for the next 15 to 20 years, that is low risk and a good return. And there has actually been a research paper, it was done for pension funds, but nevertheless we can benefit from the results of it, that showed that the asset allocation is more important than the specific investment strategy of a part of the portfolio for the overall performance of the portfolio. If one company goes bankrupt within an index fund that contains thousands of companies, if one house in your real estate portion of your portfolio doesn't rent well, it doesn't matter that much if there is enough of the other stuff. So how does that work? You take a circle, like a pie, and that circle represents your wealth. That means everything you own and don't need for ongoing costs. And then you think about of how much of a piece or percentage you would like to have of an asset in that circle. For example, I personally want the flexibility and the potential return of stocks, but I don't want to invest the time to research all the single stocks. That is why I chose well-diversified low-cost index funds. And my goal is to build long-term wealth and I have a reasonably long time horizon. So I put 10% in cash and 90% in low-cost index funds. I also have other investments like P2P lending or crypto, but that's only very, very little. Another example would be someone who is 60 years old and just had a huge cash out of several millions. And this person might say, no, I don't like to take the risks of stocks. I just want to preserve the wealth I have. So I put 80% in bonds and 20% I keep in cash. So those were two examples from the rather low risk tolerance end of the spectrum and the rather risk seeking end of the spectrum. But the possibilities here are sheer endless. And of course, you can always adapt your own model of your asset allocation over time. So the bigger it grows, the more diversified you might want to be over different asset classes. At some point, you might buy your first real estate investment or even dabble with higher risk investments. Or when you get older, you can increase the risk-free part. That also means that every once in a while, you should check in if your asset allocation still fits your needs and also your financial goals, and if the single assets are still represented in the way that you wanted them to. If not, you might adapt a little, and that's called rebalancing. To do it once a year is a good rule of thumb, want, but of course you can also do it more often, for example, twice or 4 times a year. And the time you do that is also a good time to take a look at the other factor that has an impact on your portfolio, and that is the cost. I think this topic is often underappreciated because oftentimes it's just little amounts and people are like, that doesn't matter. In some products, the cost may also be very well hidden, so you don't even know how much you're paying. Overall, and over a long period of time, the cost can actually diminish your returns significantly. To avoid a 2% fee per year from your whole portfolio, depending on the size and the time horizon, can mean to save thousands, tens of thousands, or even millions of dollars. And another aspect is that there is a variety of different costs. You have account fees for having an account at a bank or at a broker. You have transaction fees for the trading. You have management fees of the products that you buy into your portfolio. You have an advisory fee if you have a financial advisor. There are taxes, maybe you pay penalty costs. For example, when you withdraw early from certain investments than the initial agreement, or you pay an inactivity fee. And also, for example, if you own real estate, you have all the costs attached to that, like an accountant, a lawyer, renovation, contractors, and so on. So it's definitely a good idea to build awareness of those different costs and also how they impact your portfolio. And I mean, you do need to find a good balance because, of course, not investing at all in order to save the costs is not a good idea, obviously, but you don't make a mistake either by keeping the cost as low as possible. I like to differentiate between 2 types of costs, the fixed amount and the percentage. Let's go through some calculating examples. Let's say you pay a fixed amount as a transaction fee, and let's say it's $2 per trade and you buy for $100 every month. That means the overall cost per year are $24, and for the sum you invested, which is overall $1,200, that makes a 2% cost. Now let's say you pay that same $2 per trade, but instead of $100 each month, you buy in for $300 every quarter. That gives you an overall cost of $8 per year, which is the equivalent to 0.6% of your whole sum invested. So that's already quite a difference. And you might think, $24 a year, I mean, who cares? Don't be such a penny splitter. But keep in mind that those are not the only costs you pay. And let's take a look at another example of a percentage of a management fee. Let's say you have invested 100K into a fund, and the cost of that fund is 1.5% per year. That means that year you pay $1,500 in cost. Take that over a course of 10 years and you pay $15,000 in cost. When we now assume a 6% interest rate, with that 100K invested, we would end up with $179,085. And now you have to subtract that cost, so minus $15,000, and we end up with an amount of $164,085. Second example, we have again invested $100,000 into a fund which costs 0.2% per year. So then for that year you pay $200 in costs. Over the course of 10 years that makes $2,000. And here let's also assume an interest rate of 6%. So we would end up at the same $179,085 minus the cost of $2,000 makes an amount of $177,085. Now between example 1 and example 2, that is a 7.4% difference in return. So I recommend to keep them both, the fixed amount and the percentage, as low as possible. I do the same, and also if I can choose between a fixed amount and a percentage, I usually go for the fixed amount. Let's say, for example, I have the choice between a broker that takes a percentage of the amount of the order I place, and the other broker takes a fixed amount for that same order, and the rest of the criteria of those 2 different brokers are similar. I would probably go for the one with a fixed amount, and then only use higher volumes per order so that I end up at costs of 0.1 to 0.2% per order. And the beauty of course is that you only have to check them once at the time where you choose the broker or the bank or whatever. And then maybe only once in a while you can check if something cheaper popped up on the financial market. If you are now eager to start investing into your risky part of the portfolio, I recommend this video next, where I talk about simple investment strategies for beginners. I hope you got some value out of this. Thank you for watching, and I hopefully see you in the next video. Bye bye.